Hello, good evening, my viewers, and welcome to this mock debrief, CPA Paper 13, that is Public Financial Management. My name is Charles Mukasa, a tutor at MAT ABACUS Business School, Paper 13, Public Financial Management. Yeah, this is a mock debrief, which is intended to prepare or to give guidance to students who are preparing to sit their December 2025 exams. At MAT ABACUS, we normally have mock exams for paper 13 for this sitting. We did it on Monday 13th October 2025. So we are going to go through that exam, of course, with other general guidance on how you can excel in this paper 13. Yeah, the paper is always made up of two sections. That is section A, carrying 50 marks. Section A. Let me adjust my sections A and B. So section A carries 50 marks and always has one compulsory question. And then section B carries also 50 marks and has 3 questions, but you choose 2, each carrying 50 marks, 25 marks. So when we go back to section A, that compulsory question usually requires you to prepare financial statements partly. So requires preparation of financial statements. That is about between 25 to 35 marks. Are going to be about preparation of financial statements, but also sometimes some journal entries. That is debit and credit. So they'll give you scenarios and they want to show the journal entries of those. Then afterwards, you prepare financial statements. Now, this preparation of financial statements may require you either to prepare, so either you are going to prepare the statement of financial performance, performance, and then statement of financial position, and sometimes equity, statement of equity. Or it can be preparation of statement of cash flows. It can never be both this financial performance, position, and equity, and then cash flow. So it's either the other three, or one of those, or two of those, or a statement of cash flows. Of course, now key to passing this part of the question is the knowledge of the ipsases. So you must have the knowledge of ipsases. That's the International Public Sector Accounting Standards. Of course, the major one is IPSAS 1, that is preparation of financial statements, or IPSAS 2, that is cash flow statement. So depending on how the question is set. But also that's not sufficient. You're supposed to be able to adjust the additional according to the additional information given to you. So that adjustment would mean you must have the knowledge of all the ipsases, all the other ipsases, especially ipsases on assets. Yeah, most of those adjustments are going to rotate around adjustments based on non-current assets. So that is IPSAS 17 PPE, or it can be IPSAS 16 investment property, not very common property. Not very common, but sometimes comes, like I think recently in August it came, August or June. Then other IPSASes, that is IPSAS 32, that is service concession assets. IPSAS 12, inventory. IPSAS 31, intangible assets. IPSAS 21, impairment of non-cash generating assets, and other assets. But basically, when you check through, those additional notes usually rotate around those ipsases of assets. Then plus a few about revenue, not very common. Now, also key here is ability to adjust based on correction of errors. Not necessarily ipsases, but sometimes they can say there was a mischarge of expenses. Instead of maybe they spent money on fuel, but instead charged the expense on another budget line. So you should be able to adjust, reduce from where they mischarged, where they charged it wrongly by deducting that expense and then adding it to where it was supposed to have been accounted for. Yeah, sometimes that also comes. Okay, because of time, I'll proceed. Now that was preparation of financial statements. Then also, cash flow statement also requires knowledge of all those, plus IPSAS too. Now, the other part of question 1, that is section A, usually between between 15 to 25 marks. Here you're going to discuss what we usually call theory. This is a theory, theory questions. And these usually come from the first 3 topics in the syllabus. 1, introduction to PFM, where we look at what is public financial management, where we look at the categories of public entities, the users of financial statements and their information needs, the difference between public sector entities and private sector entities. Yes, usually a question can come from there, or it can come from the regulatory and institutional framework. Regulatory, where we mean the laws governing public financial management. Those laws, Public Financial Management Act, the Public Financial Management Regulation, the PPDA Act, the Leadership Board Act, the Budget Act, the Constitution, Local Government Finance, Local Government Act, Local Government Finance and Accounting Manual, the Treasury Instructions, all those, and then the institutions like Parliament, the Minister responsible for Finance, IGG, institutions like Auditor General, Accountant General, Secretary to the Treasury, the COW, the Mayor, and many others. So the roles, these actually are very, very common roles. It is very rare to find a CPA Paper 13 exam without asking the roles of some of those institutions. Then also it can come from the reporting framework. Usually here they talk, many questions have talked about the process of developing IPSASs, the role of the ISFAO in public financial management, the reporting framework, usually what guides the reporting framework. And then the other one is what they call accounting practices. And bases. This is one of the widest topics on the syllabus of paper 13, in addition to PPDA, but this one is wide. So in there, we talk about the accounting bases, we talk about the different manuals, accounting manuals like the Treasury Instructions. How do they guide in accounting, the accounting practices? Like for example, Treasury Instructions is going to talk about the different the accounting entries that are passed for recognition of revenue, recognition of expenses, liabilities, and assets. You're going to talk about the local government finance and accounting manual. You're going to talk about the government financial reporting guidelines 2024. They are going to talk about the chart of accounts, government chart of accounts, accounting practices and bases. This is one category of manuals. But then the others in this area, you can have budgeting, the budgeting function in government, preparation of the budgets and other things, preparation and execution of the national budget, preparation and execution of the local government budget, the role of the various players in the budget formulation and execution. And then in this area also have audit, that is external audit by the Office of the Auditor General. How is the audit done? What type of audits does the Auditor General do? What type of reports does the Auditor General write? Like that. Then there's also the fund management. So those are the accounting practices. So that means for you to excel in the compulsory question 1, you should be able to, 1, prepare financial statements based on IPSASs. So you must be very good in all IPSASs for you to be able to prepare the financial statements. Then also you should have read those 4 chapters, because usually that's where questions come from. Between 15 to 25 marks are going to come from those 4 chapters. Then when we got section B, as we said, has 3 questions, and you choose 2 of those. So question 2 usually has between 10 to 15 marks from PPDA, public procurement and disposal of public assets. Any area of PPDA, you expect it in question 2. Then you're also going to find other questions, other areas. Now, the accounting practices and bases also come back in question 2. Accounting practices and bases between still 10 to 15 marks can come from accounting practices. Oh, what I forgot about question 1, this other part also, the 15 to 25 marks, not very common, but what sometimes comes, the IPSASs. The examiner likes setting about IPSAS 24 in this part. That is presentation of budget information in financial statements, and any other IPSASs, but usually in theory form. You're going to discuss no calculations. Very rare that you have calculations again in the other part of question 1, in addition to the financial statements. So accounting practice, we are back to question 2. Accounting practice, 10 to 15 marks come from accounting practices and bases. And also sometimes between 0 to 10 marks. Again, some ipsases, a bit of ipsases come back. But still, usually in theory form. Then we go to question 3. Question 3 is usually purely ipsases, a combination of ipsases. The examiner usually wants you to discuss, advise management or any other authority, maybe board, etc., based on ipsases. So you're going to give you a scenario, and then you're going to advise management on accounting treatment of the transactions that are shown in a scenario, and the common ipsases will have ipsas 5, that is borrowing costs. Of course, many have come. The examiner has set many, but I'm just choosing for you those which have appeared so much. Ipsas 9, that is revenue from exchange transactions. Ipsas 12, that is inventory. Then from there, the examiner, some of these are not on the syllabus, and the examiner keeps bringing them. Maybe one time when I meet him, I'll ask him why. Of recent, the examiner has brought back leases, that is ipsas 13. That is not on the syllabus. Then the examiner sometimes brings a bit of ipsas 17, not very common in this question 3. Usually it comes in question 1, but sometimes it can come. PPE 16, investment property, also not on syllabus. Actually, this one is not on the syllabus, and that. Then from 16, the examiner is can also of recent. I saw the examiner bringing, I think for the very first time, provisions, ipsas 19. Provisions, contingent liabilities, and contingent assets. This is similar to IS 37. So don't fear some of these standards. Just use your knowledge of earlier papers. This is similar to IS 40. Then from there, ipsas 21, that is impairment of non-cash generating assets. Also not on syllabus, even this is not on the syllabus, even that. Then ipsas 22, that is presentation of information about the general government sector. 23, that is revenue from non-exchange 24 also can come here. That is presentation of budget information in financial statements. Then IPSAS 27, agriculture. I think basically, and sometimes 32, but 32 rarely comes in this question. 32 usually comes in question 1. That is service concession arrangements grantor. Okay, so that is question 3. So for you to excel in question 3, you must be very good in the IPSASs. Don't just compute and leave it there. Please advise. If the question says in the required, if they say advise management, do the calculation and then use your calculated figures to advise management. Okay, then question 4. Now this one comes basically from 3 chapters. 3 chapters, the syllabus. That is, we're going to have ethics, ethical issues in the public sector. Then another topic, chapter, this is it's called what? Public financial management. And accounting systems. And then C, you're going to have performance evaluation of public sector entities. So ethics, you're talking about the ethical conduct and the code of ethical conduct and the leadership code act. Then the public financial management and accounting systems, the IFMIS, the integrated IFMIS, integrated financial management system, the treasury account, treasury single account, debt management system. Of recent, we have the human capital management system, and so on and so forth. Okay, so basically that is how, if you're preparing for paper 13, that is how the exam appears. Of course, sometimes it can change a little from that, but from my own analysis, that's how the examiner sets the questions. Okay, so let's now embark on the mock. So the mock that was done on 13th of October at MAT ABACUS. Let's look at that question. At that question paper. So it was a simplified one, of course, having been done, in the evening. Imagine that maybe people had gotten tired by then, since it was a Monday, a working day. So we relaxed the requirements a little. Section A had 1 compulsory question, still carrying 50 marks. Section B had 3 questions, and the student was required to do only 1, to attempt only 1 out of the 3 questions, each question carrying 25 marks. So it was supposed to be done in 2 hours and 45 minutes. Of course, always read the instructions, both on the question paper and the answer booklet. So section A, as usual, required you to prepare financial statements. So it's prepare for the National Energy Infrastructure Agency for the year ended 30th June 2024. The following, that is statement of financial performance, statement of financial position, and statement of changes in equity. So in total, that part of the question carried 35 marks. So for you to prepare to do this question, always read through for the first time while trying to analyze, so that you get used to what is in there. It is very, very dangerous for you to start doing this question before you read through. Although it is compulsory, either way you're going to do it, since it's a compulsory question, but still, it is very, very advisable that you first go through this question so that you know what adjustments are there, what is in the trial balance, then you start. So they are saying the National Energy Infrastructure Agency is a government entity established to distribute electricity for domestic consumption and regional export. The following trial balance was extracted from NEIA, allow me to call it NEIA, books at 30th June 2024. So in our trial balance, we had land at valuation, power stations, office plant and equipment, then accumulated depreciation for power stations and office plant and equipment. Then we had cash and cash equivalents, inventories at cost. So when you're reading through like this, of course, in your mind, you know that, yes, I'm planning financial position, financial performance. So which one is going to financial position? Which one is going to financial performance? In your mind. So we have inventories at cost, receivables, then non-current. So now, like when they say inventories at cost, then you know that you're going to apply ipsa stelium somehow, maybe, if they give you additional information to adjust it, because it should be presented at the law of cost and net realizable value if it is for sale, or law of cost and current displacement cost if it is held for distribution for free or at a nominal charge, or for conversion into finished goods or products that will be distributed for free. Then receivables, have non-current receivables. In the public sector, you know that receivables can be current or non-current. Then long-term borrowings, capital contributions are from the government of Uganda, evaluation reserve for power stations. It's very, very important that you know, if they tell you that the evaluation reserve relates to some item, then you have to take note of that. Then we have accumulated surplus or deficit, 30th June 2023. Remember, we're preparing our financial statements for the year ended 30th June 2024, meaning that is at the opening balance. It's not yet adjusted. Transfers from other government entities, local service tax, tax back fees, licenses, fines and penalties, market fees, other operating revenue, travel inland, allowances, utilities and electricity, maintenance and repairs, fuel and lubricants, salaries and wages, domestic areas, and finance costs. Now, as we go to the additional information, maybe you could also go through it briefly to know what adjustments, but also I wouldn't advise you so much to read through, because usually there are so many. Maybe you would, at this point, lay down your structure of the financial statements that you're going to prepare. So this is IA, no, NIEA, National Energy Infrastructure Agency, Statement of Financial Performance for the year ended 30th June 2024. Okay, so we are going to have a column for notes or workings, then shillings according to the question, shillings in millions, so start with revenues. Now, you need to have the structure or the format of the statements that you're preparing in your mind. It's very, very important. So we are implementing according to the question. They are saying this entity prepares financial statements on accruals basis in accordance with the International Public Sector Accounting Standards, IPSAS. Meaning, our statements should also be compliant with IPSAS 1. So the IPSAS 1 format, revenues, we have taxes, then, sorry. So after taxes, we have fees, fines, penalties, and licenses. I saw those on the trial balance. Trial balance, I also saw transfers, from other government units. Then, according to the structure of IPSAS 1, under revenues, also we have revenues. I didn't see them this on the trial balance, but maybe you never know in additional notes. From exchange transaction, then what other revenues? I didn't see donations, but also put it. Then we have other revenues. So I have total revenues. Then we go to expenses. Under expenses, as per the IPSAS 1 format, we have wages, salaries, and employee benefits. Then we have supplies, consumables used. Then we have depreciation. Then we have impairment, if also depreciation and amortization if there. Impairment losses. If maybe we also had transfers to other government entities. We have finance costs. We have maybe subsidies or donations. Yes, an entity gave out a donation. Then other expenses. Now, when it comes to these other expenses, you can do one working for them, or this can just be a heading. And then whatever you get, you list them down here, other. Things like bad debts, things like inventory write-down values, and any other expenses that can't be classified under those categories. Okay, then after that, we shall have the surplus. Now, sometimes the examiner can also give you transfers to the treasury. That is different from transfers to other government entities. So transfer to the treasury can also come here. Oh, okay. So have total operating expenses. Then below that, we are going to have transfer to the treasury. Remember, there is a requirement that an entity should return all the unutilized money, money received from the treasury. By end of the year, if it is unutilized, should be returned. So this is where we record that transfer to the treasury. Then after that, we shall have the surplus for the year. Or the deficit. Okay. Then we go to the statement of financial position. So also very important to know the format. We start with, of course, we are going to have this column for notes. Then here we are going to have shillings. I usually prefer two columns for this, but it's okay, you can also use one. So have assets, then non-current assets. Start with non-current assets, sorry, we'll start with current assets. Also remember that we said the statement of financial position uses the format. You know, the financial position usually comes from this accounting equation, which is assets equals liability plus equity. But in this paper 13, we reorganize it and we have assets minus liabilities equal to equity. That's how our financial position should look like. So we have one side with these two and another side with this, and it must be the same total. So under current assets, we are going, I remember the trial balance, I saw cash and cash equivalents. Then I remember seeing inventory. Then I remember receivables. And leave a line, you never know, there might be another asset. Then we go to non-current assets. Sorry. So PPE, I saw annual trial balance, I saw land. You can choose to bring each separately or to call it PPE at once. So you can say land, but let's combine PPE so that we have one working. Then I also saw non-current receivables. So I think those are the ones I saw. Maybe we can leave some line just in case there's any other asset in the notes. Okay, then we go to liabilities. So we start with current liabilities. Did I see any on the trial balance? Yes, I see domestic areas. Never know, there might be another one, so we can skip a line or two. Then we go to non-current liabilities. I also saw a long-term loan. Long-term borrowing. Okay, then I'll skip maybe one or two lines. Then I put total liabilities. And I'll go to I put now net assets, which will be total assets minus total liabilities. Then I go to net assets of equity. From the trial balance, net assets of equity items, I saw capital contributions from government, Uganda. I also saw revaluation reserve. Then I saw accumulated surplus. Unless there's another which I rarely think. It's very rare to have more than those in this paper. So we shall have total net assets. Then the other statement is statement of changes in equity. So statement of changes in equity is always very simple. It comes from this part of the net assets of equity part of the financial position. Get those items there, come this side and make them columns. So I'll have capital from government of Uganda as a column. Then I'm going to have revaluation reserve and then accumulated surplus. Then I'll get the total. Okay. Then let's now go through the additional notes and see. Note 1, NIA prepares its financial statements on accruals based in accordance with the International Public Sector Accounting Standards. It is for us to note that all the adjustments we are going to do must be based on IPSAS. Number 2, the land on the trial balance was acquired on 1st July 2022 at 296 billion shillings due to the land, but due to the landslides that happened in the area, it was revalued to 291.3 billion on 30th June 2023, leading to a revaluation loss of 4.7 billion, which was charged to the surplus or deficit account the same year. Meaning there was the land was acquired 2 years back. Remember, we are reporting on 30th June 2024. That year should have started on 1st of July 2023. Yes. So the land was acquired like 2 years back. 1st July 2022, that year ended on 30th June 2023. So that was the first year. So after acquiring it, it was revalued downwards. There was a revaluation loss, which they are saying it was charged to the surplus or deficit account, meaning it was expensed in that very year. So meaning the accounting was done correctly. So it's for us to note no adjustment up to that level. If they had said it was not accounted for, then this would be a prior year error, which you will account for as per IPSAS 3. That is accounting policies, changes in accounting estimates, and prior period errors. But this was accounted for and corrected. It's not an error, because that is what IPSAS 17 PPE requires, that when the evaluation loss, we recognize it, we expense it, and reduce the value of the asset. So it was perfectly done. We got to the other part. Land was revalued at 335.3 billion as at 30th June 2024. So there is another revaluation during the current year. During the year, and you see it's a revaluation gain from 291.3 to 335. You're saying during the year, This is not another transaction. So let's first account for the revaluation gain. So IPSA 17 requires that when there is valuation gain, we are going to debit the asset. So we are going to debit land, then we are going to credit the revaluation reserve to the extent that the gain exceeds the cumulative revaluation losses. Meaning, we first of all reverse the previous revaluation losses. So we are going to credit surplus or deficit with 4.7, and then the balance shall go to the revaluation reserve. So when I check the difference between 291.3 and 335.4, 33, that is 44,000. It is beyond the 4.7. So let's do that, members. So we are going to have workings in shillings million. Very, very important to tell the examiner that your workings are going to be in a given precision. So our working one, I think, would be PPE, because that's our land. So under PPE, we have land. Then I can see we had power stations. Then equipment. Was it equipment? Plant and equipment. Office plant and equipment. So we shall start with the opening balance. So this is the opening balance. The opening balance usually has cost. From the trial balance, I can see land, the cost is 291,300. Power station is 900,500. Office plant and equipment is 354,400. Then I also have accumulated depreciation as an opening balance. Land, of course, usually has no. The other one is 360,200. This is 67,336. Of course, now shall get the net book value. Opening net book value, we need to know it before we start other things. Since we said we are reporting PPE at once, one figure, then we are going to have a column for the totals across. Okay, now let's handle note 1 because that's what brought us here. We said we are debiting land, so there is a revaluation gain of how much? It's the difference between 300 and 291,300. So 44,000. And we said we are crediting surplus or deficit, meaning our working two is going to keep some good space because PP usually has many adjustments. Working two is going to be other revenues, because by crediting surplus deficit means that is an revenue. So this is impairment. No, not impairment. Evaluation loss reversal, or you can call it just a evaluation gain. So we said the 4.7 must be credited here. Maybe we shall have another revenue. The 4.7 billion. Then the other one we said our working three is going to be revaluation reserve. Start with the trial balance. As per trial balance. So trial balance has revaluation gain reserve 9,000, but it takes to power stations. Now we are saying we are crediting, so there is a revaluation of land revaluation gain. And we say it is the difference between the revaluation gain and what has been credited to the other revenues. So this is going to be 44 minus that. So we have created revaluation gain. Okay, we move. We are saying during the year, the agency incurred land compensation costs of 9.07 billion for the Mayuge solar grid project in respect of compensation to project affected persons. Although valuation had been completed by the year end, none of the PAPs, that's project affected persons, had been paid. So they did the valuation to compensate these people, but they have not yet paid. But the opening statement says the agency incurred land compensation costs. That is a very profound statement in accounts. The moment we say incurred, and we are doing accruals accounting as mentioned here, we must recognize that cost because it was incurred. So we are going to debit now, since this was acquired, this was incurred as land compensation cost. So it is a cost incurred in direct relation to acquisition of land. So it is an attributable cost to land. And under IPSA 17, we said that the cost of an item of PPE is its purchase price plus directly attributable costs that are incurred in the process of bringing the asset to its intended, to a place and condition that what management intended it to operate. So meaning the project affected persons, cost must be debited to land. So we are going to debit land and credit. Since they have not yet paid, we are going to credit payables. That is domestic areas according to our trial balance. There's some figure called domestic areas. So you are debiting land and crediting domestic areas. So come here and say compensation of project affected persons. Debiting land with 90,700, and we said we are crediting domestic areas. So our working for is going to be domestic areas. So said as per trial balance, domestic areas on the trial balance, that is 852,664. 852,664. We are adding land compensation to PAPS. We said 90.7. We are adding it there. So note number 2 is done. We go to number 3. On 1st January 2023, MIA signed a 25-year agreement with Power Hub Uganda Limited to operate 2 public hydro dams, Achwa and Impanga. The 2 dams whose total historical cost was 324 billion with 129.6 billion accumulated depreciation were handed over to Power Hub on 1st July 2023. Despite the handover, MIA retained control over service conditions, user choice, and pricing. Now, from that introduction alone, this is very clear that this is a service concession arrangement between a grantor called MIA, whose books we are preparing, and an operator called Power Hub to operate a service concession asset called public hydro dams to provide a service called electricity generation. So it qualifies to be a service concession arrangement. So meaning the asset qualifies to be a service concession asset. So this asset is provided by the grantor because they are saying the 2 dams whose historical cost was 324 billion was handed over to Power Hub. So meaning the asset is provided by the grantor. If asserted to service concession arrangement require that if a service concession asset is provided by the grantor, then it must be reclassified from a class in which it is to another class called service concession asset. So we are going to debit service concession asset and credit the, in this case, power stations. We are crediting power stations with the net book value. They gave us the original cost and the estimated depreciation at transfer date. So we are going to use the net book value. So our working number 5 is going to be service concession asset. Now, the people who attended this paper, there are some of them who made, okay, let me not call it a mistake, but they were overwriting. In question 1, we don't interpret by writing so much. If this was question 3, there you would now to interpret and write this service concession asset should be recognized like what I've said. But in question 1, because of the time element, we don't overwrite. Analyze, but write very little if you have to write something about the standard. But you may not even write as long as you know what you're doing. Because in question 1, the examiner marks entries, not words. But not they explain if the explanation is real, to you it is required. So service concession assets. This could be many, but for this question, it is only one. So this asset is called, we can name it after either the operator or the terms. I can say Achua and Panga terms. Okay. So we are declassifying. So we are debiting service connection assets. So we're going to have the cost, transfer cost, or cost at transfer. I think it's better, cost at transfer. They said 24 billion. Then accumulated depreciation at transfer. They said that is 196.129.6. So meaning the net book value at transfer, because they are transferring to Power Hub, was that. So debit service connection asset credit PPE. So you are crediting PPE. So shall come here and say reclassification. You can bring the figures individually, or we can just take the net book value. So reclassification to service concession assets, bracket net book value. So it's under power station, so we shall credit by the net book value. Sorry, my Excel doesn't have brackets. That's why it's showing them as, accountants, we normally use brackets for negatives. It seems this one doesn't have those negatives. Sorry. Okay, so I think that is done. Then in addition, they are saying the agreement required Power Hub to carry out major upgrade of the station to meet the required service delivery quality. Power Hub completed the upgrade on 1st of July 2023. Remember, our year ends on 30th of June 2024. So 1st of July 2023 is the start of the financial year. The agreement required the year to pay 30% of the cost of the upgrade plus interest at 10% at the end of the financial year, and pay the balance in 7 annual installments at the same interest charged per annum on outstanding balance. The payment due in the year was paid on 25th June 2024. Now, IPSA started 2 service concession arrangements grantor states or requires that whenever an operator incurs a cost on either acquisition or construction or renovation or upgrade of the service concession asset. I repeat, when the operator incurs a cost on the service concession asset related to either acquisition or construction. In other words, the cost that can be capitalized on the asset, that cost also becomes a service concession asset, but also results into a liability because the grantor is not the owner of the asset, sorry, the operator. So any cost incurred on the assets is going to be recovered from the grantor. So that means the grantor has an obligation to pay or to compensate the operator. So the presence of a present obligation as a result of the past event, in this case, the event being the signing of the agreement, and whose settlement is likely to result into outflow of resources, meets the definition of a liability. So, meaning that liability should be recognized. But also remember, if I started to, we say there are two types of liabilities. It can be a financial liability or a deferred revenue liability. What determines the type of liability is the mode in which the grantor is going to compensate the operator. So in this case, if the grantor is going to compensate the operator by paying them cash or cash equivalent, then the resultant liability is a financial liability. If the grantor is going to compensate the operator by granting them a right to charge the users of the asset or granting them a right to charge the users of another revenue generating asset of the grantor, then the resultant liability is a deferred revenue liability. So in this case, ours is a financial liability. So we are going to debit service concession asset and credit financial liability. So we shall say upgrade 3,400, 3.4 billion, no, 34. And then that means our working 6 is going to be financial liability. We say this is upgrade of actual Panga dams. Said it is 34 billion. We are done. Now, what follows there is the accounting for this liability, which we can do. They said the argument required power have to carry out, power have completed the upgrade on 1st of July 2023 at a cost of 34 billion. The agreement required the heir to pay 30% of the cost of the upgrade plus interest of 10%. So interest at 10%. So equals 10% of this. So that's the amount payable, the outstanding balance. Okay. Yeah. We can say balance for payment. Then we say it's payment 30% of that. So we're going to have negative 30% of that gives me that figure. So meaning the closing balance is the difference between those two. We are going to split it into current and non-current. So current portion. They said they are going to pay this. They're saying, and they pay the balance in 7 annual installments at the same interest rate charged per annum on outstanding. So the moment, every time they are going to pay interest at 10%, but then there is a 10%, all this balance going to be paid in 7 annual installments, meaning they are going to pay in 7 years. So current portion is the amount payable next year, which is going to be 30% of that figure, 26,180, plus the interest for that year, which is 10%, which is 2618. That is the amount payable next year, becomes the current portion. So we said 30% of this. Say that plus 10% of that. Hope I've done it well. Then you have the non-current portion. So no, they said 7 installments, 7 equal installments, not 30% anymore, sorry. So we are going to have that divided by 7. But is that how it's supposed to be done? Interest at 10%. I think so. So it is 7 installments. So this is going to be paid in 7 equal installments. I don't think we need to add the interest because we are not spreading the interest to the 7 installments. So it is purely that balance to be paid in 7 equal installments. Plus the interest. So the interest shall always come. Because you charge it and also pay it. So, okay. So we are done with that. Now remember, double entry should also apply here. When you pay, for example, the interest, we are crediting financial liability, we should debit something. So that means our working 7 is going to be finance costs. Starting with the trial balance, as per trial balance. Finance costs, I remember, was 2,000. The trial balance, not so. It is 2,000. So we are adding interest on financial liability from working number 6, and that is 3,400. Don't think there's any other interest, so we can finish this at once. by adding, get our total finance cost. Okay, that's double entry for the interest. Then there's double entry for the payment, debit financial liability and credit cash and cash equivalents. So working 8, cash and cash equivalents. So we are picking as per trial balance. Forgot to would be ticking off whatever we are taking, but we can also tick. And now we took this in PPE, even this, even this, even that, and that. We have now taken cash and cash equivalents. Yeah, I think basically those. Also domestic areas, we have also now taken this finance costs. So those are now properly taken. Okay. So cash and cash, so trial balance, cash and cash equivalents is 21,300, 21,300. Then we are now having the payment, service code, payment for annual installment, service concession arrangement. So this is coming from the working 6 again, and what we are paying is 11,220. Finished. We now go to service concession assets. Okay, we shall come back for the depreciation. Let's first finish. They're saying the installed capacity of Ashu and Panga complex is 360 megawatts. However, only 140 megawatts was generated during the year, indicating impairment loss, which was assessed at 7 billion. The impairment loss was not recorded. So it's our task to record it. So there's an impairment loss of 7 billion relating to Ashu and Panga complex. So we are going to debit. It would go to impairment losses, but I remember the revaluation loss on the trial balance. So the revaluation reserve relates to power stations. And also the impairment loss, we are seeing it relates to power stations. So meaning, before you recognize an impairment loss as an expense, it must reverse any previous revaluation reserve. So we have the revaluation reserve of 9,000 and an impairment loss of 7,000. So we are going to debit revaluation reserve and credit, since Ashu and Panga complex is the same complex that was transferred to Power Hub under the service concession arrangements. It means we are going to debit service concession, credit service concession assets. So we are going to come to the service concession asset and put impairment loss on Ashu Panga Dam. Said 7,000, so it's a credit negative. And then we said we are debiting devaluation loss. So it's doing it here, impairment loss on Ashu and Panga complex, negative 7,000. Finished. So we are not debiting impairment loss expense because the loss is lower than the devaluation reserve, which was 9,000. Okay, we go to number 5. The agency depreciates power stations at 4% on straight line basis and office equipment at 10% reducing balance basis. No depreciation is charged in the year of acquisition. Very, very important. So we don't charge depreciation in the year of acquisition. So let's start with the power stations. Our power stations are divided into two. There's the power stations that were not transferred to the service concession arrangement and those that were transferred. So the same principles applies. That is how IPSAS 32 service concession arrangements apply or guide. So we're going to depreciate. Maybe our working number 8 is going to be depreciation. Working 9, depreciation, expenses. Let's do it from here. So we have power stations under PPE. So the depreciation is going to be, they said 4% for power stations on straight line. So it's going to be 4, equals 4% of the cost. Cost straight line is applied on the cost. So it is, power station is 9,500, 900, 500, but part of that cost was transferred to the service concession arrangements. So we are going to deduct the cost of, which is 324,000, which was transferred. So that one we are not depreciating it under these power stations. We are going to depreciate it where it was transferred to. So I'm going to copy this, put it here. So that's the depreciation for power stations without the service concession. Then I'm also going to bring the service concession asset. So 4%. Now remember they said there's our service concession assets are two. There's one that was transferred from the PPE, but there's also an upgrade. But the upgrade was done during the year. And they said we don't depreciate assets in the year of acquisition. So meaning we are not depreciating the 34,000. We are depreciating the opening balance. So this is 4% of the 324,000. Then lastly, we have office plant and equipment. Okay, so they said office plant and equipment is depreciated at 10% reducing balance. So it's going to be 10% of, in our working one, reducing balance is 421,736. 421,736. Okay, so we are now going to transfer those figures to where they are supposed to be. But the service concession asset, remember it had an impairment. Let's say the impairment loss was when During the year. You need to depreciate before you assess the impairment loss. Okay. Okay, I think it's okay. I think it's okay. Because we do depreciation before we impair. So meaning we are going to depreciate the 324. Okay, let's move. So we are going to transfer this depreciation to the respective assets. So service concession. So depreciation is in working 9, and here it is service concession, it is 12,960. Then under PP also have depreciation, expense. So this one, power station is that. And this is also quoted to. Okay. Then we go to lastly. No, not lastly. Included in the office plant and equipment. Oh, there was a disposal. We hurried to do the depreciation. Included in the office plant and equipment is an equivalent equipment asset which was acquired on 1st July 2021 at 240 billion shillings and was sold for 210 billion shillings on 30th of June 2024. Half of the consideration was received immediately, while the remainder is due in August 2024. Remember, our year ends on 30th June 2024. So the amount is going to remain as a receivable, that is half. The disposal transaction was not recorded. So let's record the disposal transaction. Working 10 is going to be the disposal account. Or we can say gain on disposal, gain stroke loss disposal. So they said the asset was acquired on 1st of July. So we shall first of all determine the carrying amount at disposal by looking at depreciating this asset over those years. Cost on 1st July 2021. They say this asset was bought at 240 billion. They said no depreciation in year of acquisition, so meaning there is no depreciation in that year. So the first depreciation is going to be, so depreciation in first year is not there, so we'll have depreciation in second year, or let's use dates, on 30th June. So second year, first year is 30th June 2022, so second year is 30th June 2023. So it's going to be, since it's an equipment, 10% reducing balance. So meaning net book value on 30th June 2023, that do just say plus, then I make the other negative. Then we have depreciation on 30th June 2024. That's the date of disposal. So still 10% of that. So the net book value is that. So net book value on 30th June 2024 is that. So the asset had that carrying amount at disposal. Then it was disposed at how much? Disposal proceeds. They said the asset was sold at 210 billion. So there was a disposal gain. So there was a disposal gain. Okay, now let's account for, now the other depreciation in the earlier years was accounted for because they only said the disposal transaction is the one that they didn't account for. The rest were accounted for properly. So disposal transaction, we need to recognize the carrying amount at disposal by debiting the disposal account and crediting PPE. So in this case, we are going to credit equipment. So disposal, that we are taking the net book value. So it is negative 194,400. Coincidentally, it's the same as the reclassified asset. Then, of course, we have already debited the disposal account. Then we are going to account for the disposal proceeds. They said half was received. So we are debiting cash and cash equivalents. So disposal proceeds, half. So meaning we are getting 210 divided by 2. Then the unreceived will go to receivable. So I've not seen any other receivable even on the trial balance. So to avoid having so many unnecessary workings, I'm going to bring the receivable straight here. But anyway, yeah, receivable is coming from the disposal working 10. So in bracket, since it's only 1, in bracket I can say disposal proceeds. Half of disposal proceeds. And we say that is 210 divided by 2. Finished. Then lastly, the inventory and the trial balance is the cost of the electricity distribution consumables used to distribute electricity to the public for free. These materials were nearing expiry. The net selling price of the inventory on 30th June was 1.8 billion, although it could cost the authority 2 billion to replace the material. Now remember we said IPSAS 12 applies, IPSAS 12 inventories. Now here, IPSAS 12 requires that the inventory should measure at the lower of cost and net realizable value, or lower of cost and current replacement cost, if depending on the reason for which the inventory is held. So in this case, the inventory is held for distribution, for electricity distribution for free. So it's not for sale. So it should be measured at the lower of cost and current replacement cost. So working 11. Working 11, you're having inventory. Godfrey. Godfrey.
Yes, I can hear you.
Hey, okay, it's so inventory you have as per trial balance. The inventory and the trial balance was given to us at 2400, 2400. And we are saying lower of cost, so that is the cost, and the current replacement cost. They said the net selling price of the inventory is 1.8 billion, although it could cost the authority 2 billion to replace. So take the current replacement cost. Current replacement cost 2 billion. Lower of cost is 2.4. Current replacement cost is 2, meaning we are going to take the lower. So we are going to reduce from 2,400 to 2,000, meaning the reduction is an inventory write-down value. Also call it impairment inventory. So we are done. The rest is now, we've been ticking on the trial balance. I think I forgot to tick some others that we have taken. We have taken cash and cash equivalents. We have taken inventory. Oh, sorry, we had the receivables on the trial balance. So we're supposed to have a working for receivables. So working 12, receivables. Sorry. So have as per trial balance. So receivable is 210, 100. Then we are adding proceeds, half of disposal proceeds. So I think this is also done. So I can also tick these receivables. So the rest which are not ticked, they have no adjustments. Yeah, guys, just going to take them the way they are, apart from a few like the accumulated surplus. So now let's balance what we have done so far already. So our cash and cash equivalents is that service concession asset also finished. Supposed to start from here. Domestic areas, there were only 2. Revaluation reserve. I think we are also done with it. Other revenues, there is a disposal. Gain, which was in working 11. So we're working 10, 156. So always when a figure comes from another working, let's reference it, that the examiner knows where it is coming from. But this also had a figure on the trial balance, which I think I forgot to bring. So as per trial balance, it's 98,000. So I take this also. Then we got our PPE, have the balance carried forward. Okay, I think those are our workings so far. So let's do also the other figures that which are on the trial balance but not adjusted. So we have long-term borrowings. So we are going to take them straight, long-term borrowings, no adjustment. So this is supposed to be 32,000. I see the capital contribution, no adjustment, 300,000. Let me put it in this other column. Evaluation reserve, we have adjusted it, 41,300, and it has a working, so it is working 3. Okay. If, actual depreciation surplus, we shall do it later after getting the surplus. Transfer from other government entities, it's only 1, so no adjustment. So I'm going to take it the way it is, 350. I can see local service tax, the only tax. So under tax says I'm going to put 148,500. Tax pack fees, licenses, I'm going to have another working for those revenues. So working 13. Is fees, fines, penalties, and licenses. So I'm going to bring them. I see tax pack fees. Tax pack fees is supposed to be 175,000. Then I see licenses. Licenses is going to be 230. Then fines, penalties, $200. Then market fees. Market fees is going to be 300. Add. So finished all these. Then the other one is these expenses. We have travel inland. So those fall in the category of supplies and consumables. So I have travel inland Travel inland is supposed to be 280. Allowances will go to another working called wages and employee costs, utilities, electricity. Supposed to be 85,000. Then I see fuel maintenance and repairs, 140. Then we have fuel and lubricants, 95. Good. That is it. Then lastly, working 15, wages, salaries, and employee benefits. We have allowances. Allowance is 400,000. Then salaries. Wages, 580. Good. So we are done. Now everything is ticked. We only have to transfer apart from accumulated surplus. So let's transfer this to the financial statements. Fees, fines, and penalties is our working number 14. Sorry, 13, and it is 888. Then I have revenue from exchange, nothing. Donation is nothing. Other revenues, we have other revenues. I think it was working 2. And our other revenues in working 2 is that. So that gives us the total revenue. Then wages, there is that, I'm working 15. Then I can see supplies and consumables working 14, 600,000. Then we have depreciation working 9 for 78. Impairment losses only had 1 on inventory, so working 11, and it was 400,000. Transfer not there. Finance costs. Working 7. No donations. Other expenses. We have other expenses? No. We don't have any. So total operating expenses no transfers. So our surplus is going to be that. I don't know whether it is correct. It's a deficit. I hope I've not left out anything. Okay. Then quickly we put the assets. Cash and cash equivalents is working 9. Then inventory, I think it is working 12. 30, no. Working 11, it was 2000. Our receivables were already, it's known to that. Receivables is working 12. That gives us the total non-current assets. Total current assets. Then PPE was a working 1. And the figure is meant to be what? Non-current receivables, no adjustment, 48,000. Then we added another asset, service concession assets, which was working 5. And the figure is supposed to be that. So that is our total non-current assets. So that will give us the total assets. Then domestic areas had a working. Then also the long term, so there was no other liabilities, so get total liabilities. So net assets is the difference between total assets and total liabilities. So we subtract those two. Then this side, we are supposed to do accumulated surplus. So our very last working is going to be accumulated surplus. So working 16, accumulated surplus. So as part, or you can see opening balance. 96,300 from the trial balance. I take off. Then I will add all this. Surplus deficit. Our financial performance, I pick this. It's a deficit, then I'll add the two. So working 16, we'll go to our financial position. Then we sum up. I think there's some problem somewhere. Yeah, there is a mistake actually, I think, because this figure is not matching, but let me try to check. Yeah, this is supposed to be negative. Okay. Okay, I think under liabilities, I remember we left out the service concession liability. So that means under current liabilities, we're supposed to add the financial liability also under the non-current, same thing. So financial liability, working 6. So current portion of working 6 is that. Then the non-current portion is 22,440. So when we add again, yes, our financial position now balances. Then quickly we do the changes in equity. We start with the balance, roll it forward. This one you don't do anything new. We already have the figures. It's actually this part, but moving from the opening balance to the balances that closed. So capital from the trial balance was 300, which I doubt whether it changed. Revaluation was 9,000. Then surplus was 96,300. So we get the total. Those. Then if there was any prior year errors, we list them or we adjust there. So this is adjustment for prior year errors. And then if there is any adjustment for changes in accounting policies. But for this question, there was none, so we have adjusted opening balances. This question didn't have an adjustment in that line, so nothing. Nothing. So adjusted balances are the same. Then I shall bring the changes during the year. One of them we had surplus for the year. Which we can pick from the financial performance. Surplus for the year. Then there was also other changes. You can check the workings, respective workings for this item, for this capital evaluation, especially evaluation reserve, which is working 3. We had land evaluation, so evaluation of land. And evaluation gain. Was that. Then there was also impairment reversal. Is it reversal working 3? Impairment loss, not reversal. Impairment loss on dams. This is also that 7,000. Then we have the closing balance. This must balance off with the financial position. So you see the closing balance is the same. So idea, that's how you could do a statement, the statement of financial performance, financial position, and statement of changes in equity. Okay. So I intended to have this in 2 hours, but maybe the paper had other questions. Question 2, as usual, had a bit of PPDA and then conditions under which in PPDA, the essential content of a letter of complaint to PPDA tribunal. So usually some of these questions, like now here, these are simple questions. This is a letter. It's a letter of complaint. So a letter has its essential components. Who is writing it? So in that case, the name of the complainant, the name of the entity to which the complainant is complaining, then the subject matter. What is the procurement subject matter? What was the procurement for? And also the procurement number. Then we would also talk about what was wrong. You as a complainant, what do you think was wrong? So the facts of the complaints, the grounds under which you're complaining, the laws breached, maybe the PPDA laws that were breached or violated, or the solicitation document, or anything you think was wrong. Then also, if possible, the people or the persons you think were wrong. Is it the evaluation committee? Is it the contracts committee? Is it the accounting officer? So who were those? All those should be in the letter of complaint. Also, the signature. The letter of complaint must be signed by the authorized signatory for that entity. Remember, at bidding time, there are people who are supposed to sign, who are given by the powers of Vaton. So those are the people to sign the letter of complaint. And the letter of complaint should also be in writing and also in an understandable language. Okay, so that is it. So in that case, it means you'd have to give a brief introduction. What is a letter of complaint? And then you give them. Usually, every point here earns a mark. So you have to give about 7 points or 6. And then the other one was roles, the conditions under which open international bidding may be used. When do we use an international bidding? So usually here, we're going to talk about issues like, for example, where the entity targets international bidders for lack of capacity domestically, or where there is a sole supplier or a single supplier who is not in the country, where the thresholds are met. Remember, there are thresholds for every method of bidding. For example, open international bidding can only be used if it is works for works that are not less than, I think, 500 million, and for services and supplies not less than 200 million. Okay, then I think for the issues of time, my major concentration was supposed to be on question 1, to guide you on how to answer question 1. And also I think question 3, usually is composed of ipsases. And these ipsases, usually it's a combination. The examiner rarely brings one ipsas. So for this, the mock exam, question 3 had 2 parts. Part 1 was saying Kavule District Local Government is involved in a series of construction works under its force account mechanism strategy. The following transactions were extracted from the district store's ledger for cement during the financial year ended 30th June 2025. The purchase price of the cement was given, then the number of bags was given. So they're saying July opening balance, then August there was an issue, October there was a purchase, December was a purchase, February was an issue, March was a purchase, June was an issue. The purchase price of the cement was 32,000 per bag in June 2025. Required with difference to the application applicable IPSAS, determine the total value of cement issued during the financial year and the value of closing inventory as of 30th June 2025 using the FIFO, that is first in, first out method, and also the weighted average cost method. So if, for example, we are to do, let's do the FIFO. FIFO is first in, first out, meaning the first inventory to come in is expected to be the first to go out. So we are going to use a simple table to do the issuing. So we shall have a table that has yeah, you can have the quantity, the particulars. Then we have the quantity. Maybe we can start with the dates. Date, particulars, the quantity, then we shall have the batches. Batch 1, because I can still have different batches. We'll have the opening balance, then the one of October, the one of December, and the one of March. So batch 1 up to batch 4. Then, so we have July 2024. Particulars, this was opening balance. So quantity, the quantity of opening balance is 1,200. So this was batch 1. So then we are going to have now the issues. Issue. The first issue happened in August of 1,000 bags. So first in, first out, this should have come from batch 1. So we can do them as negatives. So under here, okay, I think we needed to first do the batch quantity here. So this is 1,000. Batch 2, which came in October, came with 800 bags. Then batch 3. Okay, let's move month by month. I think this will disturb us. So this is negative 1,000, meaning now the balance, July balance, under the quantity, that one was 1,200, sorry. We have only 200, and here everything has gone. Batch 1 is the one that had 1,200. So it is made up of batch 1. Then we come to August. No, this is actually August. This is August balance. Then we come to the next month was October. So October there was purchase. So October there was purchase of how many units? 800, and this was batch 2. So it is here. So no other transaction in October, so meaning October balance was made up of here 1,000, but the 1,000 was 800 here and 200 here. Then we have December. So our next month in December there was still purchase People have not skipped any issue. They bought 1,400. This was the third batch. So no other transaction, meaning December balance is now 24,000. No, sorry, 2,400. Made up like that. Then we came to Feb. So Feb was issued. They issued 900. 900. First in, first out, meaning 200 here, then 100 here. That will have the, not 100, sorry, 200 here, then 700 here. So meaning Feb balance, we're going to have this. Then lastly, sorry, not lastly, March. So under March, we had batches. We bought 600 in the fourth batch. No other transaction, so this is March balance. So 21,000 to 2,100 made up of those. Second batch, third batch, fourth batch. Now when we come to June, we are issuing how many? 700. First in, first out, so negative 100 here, and then 600 here. Make up the 700 and 0 here. So now June balance, so that is our June balance. That's the distribution table, or you can call the stores the store card. Now valuation, the question requires us so store card using FIFO. Now we are going to value, they want us to value the total cement issued during the year. Total cement issued during the financial year. We are going now to look at the issues. So we have the first issue was August. So August issue is made up of batch 1, which is 1,000 units times the price for August, which was, no, not the price for August, the July price, 35,000. Then we have the Feb issue. Feb issue. So this is going to give us in Feb we issued 200 from batch 1, so that is 200 times 35. Then plus, in Feb, we also issued another 700 times the price. 700 came from batch 2, and batch 2 came at a price of 40. Also 35. Then we have the June issue. How many issues were they? 3. June issue. June issue was made up of June. So we have 100 from batch 2. So 100 from batch 2, and batch 2 came in October. So times 40,000. Then we are looking at the June issue. We had 600, which came from batch 3, and batch 3 is the December batch, which came at 30,000. So this is 600. Total that. So the total value of cement using the FIFO was 92 million. Then we have to valuation. This was valuation of issued cement. Then this is valuation of closing balance. So closing balance from our valuation table, we have 800 from batch 3 and 600 from batch 4. So we shall have value equals 800 times batch 3 prices, that is October, 30,000. No, batch 3 is December, 30,000 plus 600 times batch 4 prices, which is March, 35,500. So that gives us the answer. $45,300. Hope I've done it correctly. 30 and that. But remember, IPSA still requires that inventory should be valued at the lower of cost and net realizable value. Inventory is valued at the lower of cost. And this one is not for sale, so and current replacement cost as per IPSAS 2. Current cost as per IPSAS 2, 20 to 12, inventory. Since it is held for construction of facilities that are not for sale. So that was the cost. So we need to look the current replacement cost. Current replacement cost. They said the purchase price of cement was 32,000 per bag in June, equals 32,000 times 1,400 units. Which is 44. So the lower of cost, so cost is 45,300, current replacement cost is 44, meaning inventory should be valued at its current replacement cost. So since cost is higher, okay, let me read. Since current replacement cost is lower than historical cost, cement, closing cement shall be measured below at its current replacement cost of shillings 44,800, closing an inventory, write down value of shillings, how much? This minus that, 500,000. Okay, I think I'll stop this session at that. Maybe you also try out the other part where you're going to use the weighted average cost. Because of the time, I can't going it beyond this. Thank you for listening to me. Once again, I'm Charles, CPA Charles Mukasa, tutoring paper 13 at MAT ABACUS Business School. Thank you.